Hi guys, I'm Nicola McKenzie, founder and mortgage advisor here at Dunham McCarthy Mortgages. And in today's video, I'm going to be looking at whether or not you should max out your mortgage borrowing. So to find out, stay tuned. So before we get into today's video, guys, if you enjoy this video and it's useful for you, make sure that you hit the subscribe button and the notification bell so that you never miss any future uploads. And of course, if you're watching this video, then I would put in a good guess that you are looking to get a mortgage in the near future. In which case, head over to our website, dm.mortgage, and book in for a free of charge appointment so that you can find out more from one of our mortgage advisors here at the team, how much you can borrow, and we can guide you on your next steps. Now, the first place I'm going to start is often when you do go for a mortgage assessment, the first thing on people's mind generally is how much can I borrow, which I totally understand because that's obviously going to dictate what kind of properties you then go out and view and look at. But the question I'm looking at in today's video is, should you max out the amount that you are going to borrow? So a lender often is going to tell you what the maximum is that you can borrow on a mortgage. Now, whether or not you go to the maximum level of borrowing, of course, is a very personal decision. Although this video, I will be looking at highlighting some of the pros and cons and risks if you do choose to go up to that maximum, because there are some things to consider. Now, the main advantage if you do go out and buy a bigger, more expensive property is that generally speaking, the more you spend on a property, the more equity likely you are going to build up over time. So you're going to potentially see more from your investment in terms of how much the asset is worth. The more something costs initially is likely to grow more over time. And equity can be useful over the long term for a variety of reasons, because it can help with, supporting your retirement plans, for example. It could help you build a buy-to-let portfolio if you were to tap into that equity later down the line. It could potentially mean that you've got so many more options available to you the more equity you have in your home. And it could mean more money to pass down to future generations. So like I say, in other words, the more you pay for a property today, the more it's likely to be worth in future years. Now, you also need to think about what your future goals are in terms of whether or not you decide to max out your borrowing. Is this your forever home? Are you likely to stay there, indefinitely? Is this the dream property you always wanted to buy and you're not looking at moving for a while? In which case, maybe it is worth considering going to the maximum, because you probably want to make sure that you get the right property on the first try. If that's your goal, you don't plan on moving again. Now, it's really important, guys, and again, I'm going to be expanding on this question more using my mortgage hat, because as a mortgage advisor, that's what we're here to do. But the lender choice is, I feel, again, one of those really key factors that you need to take into account when making the decision whether or not to max out the borrowing. Now sometimes what we're used to seeing is some clients will want to try as many lenders as possible to find that one lender that's going to enhance the amount that they'll lend compared to all of the other lenders. And that's fine, guys, if that's your goal. But there are risks involved with that, and you have to understand what those risks are. Because when you find the property that you want, what if that lender that you originally found no longer has rates that are as favourable as when you did the affordability calculations? Because rates change all the time. The best lender today isn't necessarily the best lender tomorrow. Now, another key point to bear in mind is that lender criteria changes. So, for example, we had a scenario where there's a high street bank that offers a product that does multiply your income by 5.5 times. Now, what happened in this scenario is that in order to qualify for that product, you had to earn in excess of £31,000 as a salary. With the cost of living rises and everything else that's changing right now in the current economic climate, the lender changed the goalpost and said, you now have to have an income in excess of £37,000. So we had a client who was desperately just trying to find a lender that was going to propel the amount that she needed to borrow more than the others. So we used this particular lender to get the affordability calculations and explained the risks, as I'm doing in this video. She found a property, and lo and behold, the lender criteria changed, and they were then asking for a higher salary in order to qualify for that particular product. Now, in that scenario, it turned out to be okay because she actually did have the extra cash to stump up a higher deposit. But the point is, had she have not had that, then there were no other, or very few other, lender alternatives to turn to. So what I'm saying is that if you end up maxing out your borrowing, but it's limiting the lender choices available to you, then that comes with a risk, because if that lender's criteria changes or the rates change, then that may leave very few, if any, alternative options for you to consider. Another thing to think about as well, guys, if you're maxing out borrowing but there's only one or two lenders that might accept you on that basis, let's say that the lender goes out and does a valuation on the property, because it may not be related to the lender criteria changing. It could be down to the property itself and the specifications of the property. So let's say that you did a mortgage with HSBC and they went out, did a valuation, and let's say that there was spray foam on the inside of the roof. That's something that's in HSBC's criteria that they don't accept. So let's say that you had gone to HSBC purely on the basis that they were one of the few lenders that would have given you 5.5 times your income instead of the typical 4.5. Well, if the property you're buying doesn't accept, if the property you're buying, that particular lender doesn't accept the specification of that property, again, you're a bit stuck, because just because one lender says that they may not accept spray foam on the inside of a roof, that doesn't mean that another lender won't, because in a situation like that, I can think of other lenders that would have been okay with that. So again, it's just about limiting your options and thinking about the risks associated with that. What is your lifestyle and what are your monthly outgoings? Just because a bank says that you can borrow a certain amount of money, that doesn't necessarily mean that you should take it. It's you paying that mortgage payment, not the bank, not anybody else. So essentially, how much you decide to borrow in the end is very much down to your personal viewpoint as to what else you're intending to do with your disposable income. Everybody's lifestyle is very, very different. So even though a bank may say to two people, you can both borrow £200,000, one of those two people might love going shopping, eating out 5 times a week. The next person may not want to do any of that. So are those two people going to be comfortable with the same mortgage payment? Maybe not. Is it appropriate for them to both accept the 200k? Maybe not. So my advice here is to draw up a budget planner, estimating as best as you can what you think the expenses related to the new property are going to be. So your bills, your utility, your water, your council tax, all of that. Then work out exactly how much you've got left over at the end of the month. From this, you then need to work out what figure is comfortable for you to want to commit to a mortgage. It's also something to think about in terms of whether or not you should max out to, get the maximum amount of borrowing, should I say. It is also dependent on your personal circumstances. So let's say that you do earn a basic salary, you haven't got any overtime or commission. I would say, again, I'm generalising here, but generally speaking, it's usually going to be safer for you to max out the borrowing compared to somebody that does earn overtime, bonuses, etc. The reason being is because overtime varies, and the lender is going to be focused on your pay slips leading up to the application. So let's say that we do an assessment and it comes back with a maximum borrowing of £200,000. Then you go out and find a property, but it takes you 3 to 4 months to actually find that property. Let's say in that preceding 3 or 4 months, I don't know, you've done a little bit less overtime because you were ill, or there's a variety of reasons why things might change. Well, if you've maxed out the borrowing based on the affordability calculation 3 or 4 months before you found the property, then at that point when you found the property and you apply, you could be looking at a reduced level of borrowing. So again, here at Dun & McCarthy, what we would usually do is work out your affordability, but still advise you on leaving some wiggle room in it to account for things like this. And how much wiggle room is in it is going to depend on, again, a variety of factors. But usually we would advise you what the maximum is that you can borrow, but also tell you where a more comfortable and safer level of borrowing is as well. And then it's up to you whether or not you want to take that little bit of added risk. And it's also worth me mentioning as well that when you do go up to the maximum borrowing, or even if you don't, it's not until you fully apply for a mortgage that an underwriter gets involved. And an underwriter is a person in most cases that works at the bank that's going to be looking at it as a human. It's no longer a computer. An agreement in principle in most cases is a computer saying yes or no. But when you actually apply for a mortgage, a human underwriter often gets assigned to the case. And that person is going to look through your pay slips and all of the other details and decide if you are an appropriate person to offer that mortgage to. So the point I'm making is, again, if you've maxed out the borrowing there and the underwriter sees something in your case that they don't necessarily like and they reduce the level of borrowing, then again, that could leave you stuck if you don't have additional deposit to stump up. You know, so at that point where an underwriter gets assigned to the case, to some extent, the application can become subjective at that point. So the point is, if you go to the maximum level of borrowing, it's just really important that you understand the risks involved. And I'm not telling you not to necessarily go to the maximum. What I am saying is that the risk in going to the maximum is going to vary from person to person, and also depending on which lender choices you have available to you. So to find out the maximum amount you can borrow, and maybe a safer level of borrowing, if you decide that you would prefer to do that, then make sure that you head over to our website, dm.mortgage, and book in for a free of charge appointment. And we can, like I say, tell you what the maximum level of borrowing is, and we will let you know if we would advise that you go to that maximum level or not, depending on your circumstances. Of course, guys, as always, if today's video has been useful, then make sure that you give it a thumbs up and also hit that subscribe button and the notification bell so that you never miss a future video upload. And I will look forward to seeing you in our next video. Till then, take care.